It's done very, very well. Ajay Vora is with us, Head of Equities at Nuvama Asset Management. Ajay, good to have you with us here. Thanks for your time. Let me just sort of kick it off with your thoughts here on Coal India and some of the others who've all come back in a very strong way. Old economy, old economy sectors largely, very high dividend yields. Do you own any of them? What's the view from here?
Yeah, hi Prashant, good afternoon and thanks for having me on your show. In PSUs, as you rightly said, there has been significant transformation in certain pockets, both in terms of, numbers, in terms of outlook, and maybe, that is getting reflected across many stocks. And needless to say that, they were available pretty cheap, I would say a year back or even 6 months back. If you look at the entire PSU basket, and we should not generalize that, but broadly, 6 months back, the entire market cap of all PSU companies put together was somewhere close to $450 billion, which is say closer to 35 lakh crores. And over last 6 months, as we speak, it stands at $750 billion, closer to 65 lakh crores. So, there are certain pockets where I would say that, some irrational or euphoric movement has taken place. Like if you look at, stocks like say ITI, for example, market cap is 35,000 crore and still, negative operating profit. And on the other hand, you will find certain companies where, EBITDA can be $1 billion and market cap is still $2 billion. So, so in certain pockets, the pricing has played out basis operational, but there are still certain pockets in PSUs where there is euphoria kind of a sentiment.
Okay, all right. Hi, Ajay. Good afternoon and good to see you. We're Nigel on this side. First of all, I want to tell you, congratulations. I think the last time we joined, you spoke about some OMCs and they have done splendidly well from there. That's the pocket that you liked, I think. And the pharma sector as well. These two, at least I recall that you've spoken about. So what's the view from here on? You've got the call right, but that's a tricky point, right? Now, what do you do? Do you believe there's some more steam left? Would you be a buyer even at these levels?
Yeah, so hi Nigel. So you're right, we were extremely positive on OMC space. And if you go back, couple of quarters, you'll see that, say suppose a company like HPCL, the market cap was closer to 35,000 crores. And there was a possibility of they delivering close to 20,000 crore of EBITDA. And most importantly, Street was building in a sharp decline in the following year, basis the marketing margins and also the GRMs, which has completely turned around. So if you look at the marketing margins now, they are way higher than what the Street was building in maybe 2-3 quarters back. And going forward also, we don't see those kind of estimates holding true. It will get revised. And on the other hand, if you look at the refining margins as well, Street was building in, pretty conservative numbers over there. So all in all, we thought that, on a steady state, numbers can be pretty high versus what Street was building in. And the EV, if you look at it, stocks were trading at 1 time price to book and 1.5, 2 times EV to EBITDA, and that is what has panned out over last, I would say, 3 months. The entire space is up almost, I would say, anywhere between 50 to 70%. And I still believe that from here on, we are getting into a very strong refining cycle going into FY25. And even if we have a central election and we had state elections, there has not been a major dip as such on the marketing margin side. So I think if the numbers, what Street is building in, will get upgraded over next couple of quarters, and we'll see stock doing well even from here on.
Okay, got that, Ajay. Hi, good afternoon. I want to talk to you about Hindustan Unilever. Now the stock is down almost 4% because the numbers are obviously they're worse off than even the weakest expectations out there. So the question is really, what is the sense that you get when you talk to clients about FMCG and lever? Do clients see this as a lever-specific issue? And B, could this have a bit of a rub-off effect on the rest of the staples? Or is it a case that, most of the institutions are anyway underweight on staples FMCG, so it shouldn't have a wider market fallout in that sense?
Yeah, hi Surabhi. So I think at the broader level, what sense we get is, there are two things playing out in a big way. One is over-ownership and secondly is the valuation. So, wherever the valuations are pretty high, and if you look at, Unilever, the valuation is somewhere around 55 times, and you are getting growth, which is, less than 10%. And I think investors have been holding these names for a fairly long time. There is nothing wrong with the company, nothing wrong with the business. But the point is that the broader market has got so attractive in terms of the valuations and also the growth rates that people will have to move on to different stocks, different sectors where they can end up making outperformance. So my sense is that and this business is more dependent on the rural segment, which, as we all know, is still lagging since quite a while. Till the time that recovers, I think the volume growth will stay subdued. Once you have volume growth picking up and coming back to those 7-8%, I think you can see some sort of bottoming out in these names. But as I said, the over ownership and valuation is the theme which is playing out in many large cap names, and we saw it across banks and even IT to some extent. So that is, I think, the overarching theme over here.
No, fair point, but one just wonders whether this whole rural weakness argument really holds on its own, because we've seen the recovery in two-wheelers, right? I mean, they're reporting better numbers in domestic sales as well, and that's also a rural play. So somehow it's not adding up. Clearly, there's more to it. Also, just the second part of to that question, is this a lever-specific issue, or do you think this could lead to additional selling in some of the peer companies as well?
So it can be a lever-specific issue because there are certain categories of their business which are highly penetrated now. So expecting very high volume growth in those categories may not hold true, and therefore those businesses can stagnate, or I would say grow at a lower pace. Whereas other FMCG companies where the categories are still not that penetrated can continue to see a little higher, or I would say relatively better volume growth. So my sense is that it can be to some extent a lever kind of an issue.
Ajay, sorry, Nigel was asking about OMCs. Did you have a call on standalone refiners as well, or am my memory faltering? CPCL and MRPL.
I think we spoke about this company, Chennai Petro, which has done exceedingly well.
I mean, it's done
as a standalone refinery. And as I said, there are stocks in market where there is a negative operating profit and $4 billion of market cap, whereas this company can end up delivering $1 billion EBITDA, and still the market cap is only $2 billion.
So you still, right? So still bullish on this one, Chennai Petro?
Yeah, so we hold it across all our clients.
Wow, I mean, we're sort of getting through January this year. It's up 20%, 25%, and of course, I mean, 2023 was a phenomenal year. From 200. At the close of 2023, it basically, I think, ended at 700. So it was in 23, it was a three-bagger, more than a three-bagger actually. So that's Chennai Petro for you. Nimesh actually, as part of his editors roundtable, put out a list of P multiples where they're trading as compared to averages. Just based on that, this looked the most egregious. I mean, I think now it's trading about 8-9 times P from what I remember, on those points. And the historical average, of course, is very low. But Ajay is saying that maybe that's not relevant. Things are looking much better here for oil marketing and maybe even standalone refiners, etc. as well. Anything new, Ajay? Any new sort of addition to the portfolio? Anything you'd like to talk about?
So a couple of themes, we are still pretty positive. I think, the whole housing finance companies are looking pretty cheap. We have seen the kind of action on the real estate side, and there I think a large part of the positives are getting built in. But if you look at most of the housing finance companies and start from say $500 million market cap to say $10 billion market cap, all these names are still looking pretty attractive considering the growth path which they have right now. And my sense is that once the interest rate starts falling, these guys will end up doing pretty well. So overall, housing finance companies is one theme where we are positive. And secondly, this whole tire names, which we have been bullish since quite a while, that has picked up pretty well of late. But we continue to be positive on this entire tire space because, Prashant, if you look at the business, 65-70% is completely consumer business. And if the raw material prices stay where they are, even the B2B business, they'll end up making reasonably good margins. And what Street is building in, they are fearing that the margins will start correcting. But as I said, that if raw material stays here, the margins can actually move higher. And if you look at the valuations, they are still trading at I would say anywhere between 12 to 15 times PE, or maybe 4 to 5 times EV to EBITDA. So my sense is that, even this space can continue to do well from here on.
Okay, got that. Well, Ajay, it's been a pleasure speaking with you. Thank you so much for joining in and taking us through this trading Saturday. You enjoy the rest of your weekend and the Monday off.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.